Hey everyone, just a reminder to tell Joe's mom she looks like she lost weight because I accidentally parked on the grass again.
Hey guys, mics are hot. Quiet on the set.
Live from Joe's mom's basement, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor, Doug, and as they say, a verbal contract isn't worth the paper it's written on, which is why today we're diving into a written contract we all need: insurance. MIT professor and author Amy Finkelstein will take you behind the scenes of the insurance market so you can make better choices. For our TikTok Minute, a reminder that maybe we could pay more attention on the job. Plus, in our headlines, we'll detail the best places in the world to live. Plus, we'll throw out the Haven Lifeline to a lucky stacker, and then I'll share some heartwarming trivia. And now, two guys who want to ensure that you'll have stacks of Benjamins when you need them, Joe and O-G-G-G-G.
Hey there, stackers, and a happy Monday to you. I am Joe Saul-Sehy, Average Joe Money on Twitter. You found us. You found the Stacking Benjamin Show. Sit back, relax, grab your favorite beverage because we're about to have an hour of fun financial nerdery. And man, are we bringing it today? You know why we're bringing it? Because we got this guy across the card table from me. Mr. OG is here. How are you, my friend?
I'm pretty good, all things considering. It's almost the end of January.
It is. Can you believe it? Where did January go?
So yeah, good riddance.
Yeah, I was on a flight this weekend, and our flights were delayed because of de-icing. Which is always fantastic. I got to run through the Atlanta airport.
Better than them being crashed. So
yes, no, absolutely. I will take door number one, please. Door number one.
Use extra de-icing fluid if you can.
Yes. We're going to talk, OG, today about how the insurance market works. Doug, as you said so eloquently earlier, Amy Finkelstein, of course, MIT professor, she's got just... This is so interesting when you dive into it. It sounds like the world's most boring topic on top, but then you start diving in. And well, Doug, you and I previewed this a little bit. This is some interesting stuff that she's going to be talking about.
Yeah, no, it always is.
Amy, great headline, world's weirdest TikTok minute. Just another episode, another day in the basement. So let's roll.
Hello, darlings. And now it's time for your favorite part of the show, our Stacking Benjamin's headlines.
Our headline today comes to us from Lensa.com. New research dives into, OG, the places where you can earn the most money in the world. So if you're thinking about being mobile, we've talked before about being mobile. What are the young professional hotspots if you're looking for a job? Well, the top places with job availability. Number one is Singapore. Singapore has the most jobs. Number two, Luxembourg.
What?
Both people live in Luxembourg.
They both quit. And so now there's some openings.
There's some openings. Nice.
And number three is the United States. But what's funny about this is that, Singapore, they show this Singapore skyline, which is really cool. They show the water. United States, they show the Empire State Building. Luxembourg, they show a castle. Of course, where all the residents live.
You can be a servant.
It would be great. The places that pay the highest, that highest average annual salary. Any guesses, OG, where highest annual salary would be?
Dubai.
It is not. You know what's weird? Qatar or Qatar. I'm not sure. I hear people pronounce that word so many ways. Is number 9. But the only country in that region that made the list. Number 1 is Switzerland. $7,500 a week and $90,000, just over $90,000 a month. Norway is number 2 at $84,000 a month. Luxembourg, number 3 at $81,000. United States, by the way, 5th with $70,430
a month.
They put all this a day.
Per unit of time that we mostly measure income
No,
and
I'm sorry.
salary by.
Did I? As I was going through these, I thought I said weekly and then changed it up to yearly, but I never.
I heard a month in there, and I'm like, holy cow!
I made the transition in my head. I might have said per month. That's per year, peeps. So let's go back to that. $90,000 for Switzerland, Norway just over 84,000, 81,000 for Luxembourg. Ireland's number 4, by the way, at 74,000. United States at number 5 at 70. Denmark number 6, Singapore number 7, Sweden number 8, Qatar number 9, Australia 10.
Please keep going.
Yeah, number 18, number 66, number 92. Here's the thing, though, OG. You put these numbers together. People might think, hey, I should move to Norway. I should move to Switzerland. Guess what else is very high in those countries?
Discipline and accountability. I don't know. What is?
Cost of living is incredibly high.
Yes.
In Norway, especially.
So it's not always greener on the other side of the fence.
Exactly. The number one country, according to Insights by Lensa, which helps people search for jobs and find jobs, is the United States. Because of the lower cost of living, the available entertainment, banking, they go through a bunch of different options for young professionals. Luxembourg still clocks in at number 2, by the way.
I was going to say, when we lived in Michigan and decided to explore moving and ended up in Texas, one of the things that I think most people don't really appreciate in the U.S. is how you can quite literally travel 4 time zones, 3,000 miles, and you have virtually the same government, you have the same money, you have the same banking system, you have the same language, you have the same, all of the stuff is the same. And you can control, do I want better weather, or do I want lower cost of living, or do I want, you can make a list of the 20 things that you want to do or kind of hang out with, or do, whatever the case, whatever's most important to you. And, you might not be able to pull off all 20 of them, but you can probably knock out half of them. Whereas if you're in the UK and you're like, I hate this weather, I need to be someplace warm, you're going 5 countries away and different language, and you need permission to go there and live there for an extended period of time and all that stuff. And here it's like, you just throw your crap in a U-Haul and go, I want to be by the mountains, and boom, you can do that. So it's quite a blessing, I think, that most of us forget about.
No, it is very much so. You look at the third country on this, Romania. Romania wasn't on either of those lists that I told you about earlier, but Romania, the cost of living is so low that it pops up on the list.
Yeah, low cost of living, but there's different challenges there too, I'm sure.
Sure. No, when I was in Budapest, they were talking about how the infrastructure is all crumbling.
I said the same thing.
Is.
It's so annoying.
What?
There's no H, but you have to say it. I got it.
Okay, but what's funny is I pronounced it wrong. I pronounced it the wrong way. So you guys can laugh at me. I pronounced it Budapest until I went there, and I was told by the people that live there that we're idiots and that we're doing it wrong. So whatever, you guys are right.
Island next.
You guys are right. You've got it. You got it. Go ahead.
Let's go to Travis City.
So Budapest, when I was in Budapest.
Thank you.
Yes.
Thank you for making it more American for me.
Yes. What happened was... What happened was, they talked about how the infrastructure is all crumbling, but the cost of living, like going out to restaurants, the nightlife, it was phenomenal. Beautiful buildings, all kinds of cool stuff.
There's a give and take.
Yeah. And Luxembourg's there for the exact opposite. Luxembourg, very high cost of living, expensive place to live, but they're on there because the access and how close you are to sites and all kinds of beauty all around you. And the fact that you can make a lot of money, even though you're going to spend a lot. And according to this survey, they think that it's worth it. United States, kind of a good middle ground there between all those things. You can dive into these statistics and you can miss the pieces, OG. So to your point, if you're somebody that really likes low cost of living, well, then Romania might be your spot. If you want to be close to the sites and you're okay with a very high cost of living, well, then Norway or Luxembourg. I feel like we don't dive enough. Number one, we don't start with what am I really looking for? And number two is we don't really dive into these stats and see, where are these numbers actually coming from?
On the advent of a little bit more mobile work life, I think also helps kind of expand the horizons here a little bit.
Absolutely. I got a piece here, by the way, speaking of statistics and how often I think statistics can fool you. This is a piece from Psychology Today written by Dr. Glenn Gaher. Glenn talks about 3 ways where statistics can fool you. Number one is amplifying the importance of statistical significance. Statistical significance is limited in its importance, while statistical significance can tell you that some finding is likely to represent how things are in terms of patterns at the broader level. Based on how statistical significance is determined, you can, in fact, never be fully certain you're correct. We've seen this on our show before, where people will say, well, we talked to 45 people and we came up with something very statistically significant. Is it statistically significant?
On 45 people.
On 45 people. And also, if you think about the fact that, we will often say, 60% of people haven't done this. And we've had people write us back going, well, you could present that the exact opposite way and go, hey, 40% of the people then are ahead of the game. Like, that's a huge number. You can go from
I'd like to remind the audience at this point that I got a B- barely in statistics in my graduate school work. So I have nothing valuable to add on the statistics front. Thank you.
No, because you're a guy that always, when we're talking about statistics, you're like,
I didn't say that I can't spot BS. That's a different thing.
That sound is him being
that's
confused.
what this piece is all about, is how to spot BS.
Yeah, that's just...
Capitalizing on type 1 error. So without getting too far into the details, type 1 error exists when a researcher finds that one result's significantly significant, but then kind of rolls that ball, OG, to say, oh, because this is significant, then these things must be. No. You can't correlate just based on this one thing. And then third, of course, is that we use too small of a sample size. Like what's the sample size? Did we really talk to enough people? And can we amplify that?
It's the size of your sample.
It actually is the size of the sample. Actually, it is the size of the sample that matters. Yes.
Really?
Contrary to everything you've been told. We will link to all these, and we're going to dive more into how to spot BS in statistics, and also these young professional hotspots. If you're mobile and you're looking to maybe move and you know why you're moving, well, then we'll link to all these. And of course, in our 201, Kevin Bailey will dive even deeper into these topics. Time, guys, for our TikTok Minute. This is the part of the show where we find something that a TikTok creator shining a light on. In this case, this wasn't actually made on TikTok, a TikTok creator shining a light on. And Doug, you think this is going to be gold or air quotes gold?
Gold, Jerry. It's going to be gold.
I think you're right, Doug. We're often not that great at our jobs. We don't pay attention enough as we should. And this is just a good reminder from the show Reno 911 that I saw the clip on TikTok. 2 police officers driving through a taco place drive-through. And this is what the person at the drive-through says to them. And by the way, when she says that there's something in my teeth, the only piece of this you won't get audio for is she's pointing at her tooth and she's moving her thumb up and down while she points with one finger at her tooth. And if you do that, well, look at that motion yourself as you make it, and I think you'll get where she's going with that.
Hello. How you doing today, ma'am?
Hi, I'm terrific. How are you guys doing?
We're doing good.
Just great. Sorry for the holdup, guys.
It's all right.
I knew I held you up. That's
no
probably a crime, isn't it?
Not at all. No problem. But could you hurry up? Because we got a lot of
Can you
crime
believe
to...
$9 for tacos? I mean, that's highway robbery, isn't it?
That's not bad, actually.
Highway robbery?
Fair price, actually. Yeah.
There you go, guys.
Okay. Oh, got it. Oh. Got it. Yep.
It's not a crime to make you wait.
Not at all, ma'am. You have a good day.
Do I have taco in my teeth? Huh?
No, I don't think so.
Thank you.
Bye-bye.
I've got a note here. Officer, there are 2 armed men inside.
I hope there's 2 armed men back there. One armed guy's not going to be able to make a taco.
Just completely oblivious.
Oh, I get it.
Oh,
This was a funny. Someone made a funny. Got it.
yeah. I don't know if you've seen the show Reno 911, but that's kind of the entire show. Obliviousness of
Got it.
some of our finest.
Story of my life.
Yeah, you might have to pay a little bit more attention at work. I think these guys got to pay just a little bit more attention. Hey, it's highway robbery, $9 for tacos, isn't it? Boy, it's a crime. Like how many freaking clues does she need to give them? Coming up next, Amy Finkelstein is not only a professor at MIT, she's co-author of a new book from Yale Press, Risky Business: Why Insurance Markets Fail and What to Do About It. The more you understand about just the basics of how insurance works, the better insurance decisions you're going to make. I see all the time in internet forums, people using some shorthand that sometimes works, OG, and sometimes doesn't. A lot of times it doesn't because you can tell by the shorthand they're using that they just don't understand how the insurance market works. And if you do, I think you're going to make better decisions. The cool thing I like about Amy is she's fantastic at telling stories that get the point across about how to think about insurance. Even me, and I love insurance, as I was reading through her work, I couldn't believe how interesting some of these stories were. We're about to hear them, but as a way to get there, Doug, you got some trivia for us, I think.
Hey there, Stackers. I'm Joe's mom's neighbor, Doug, and I've been thinking about just what a loss it would be if you-know-who weren't around. You know who I'm talking about, right? Well, I think we need key person insurance. According to Investopedia, it's a life insurance policy that a company purchases on the life of an owner, top executive, or another individual considered critical to the business. You all know who the voice of this business is. The whole reason anybody's even listening. No, not you, Doug. Wait a minute. It says here, we could replace you with a monkey, an Alexa, and a loudspeaker. That's pretty rude. You can just insure your parts as well. Okay, not those parts. Well, maybe. So my question is, whose famous smile is rumored to be insuranced? I can't believe I just said that. Is rumored to be insuranced for $30 million. I'll be right back after I practice my new masterclass on how to exceed an unlimited budget. Hey there, Stackers. I'm toenail insurer and high-risk hair haver, Joe's mom's neighbor, Doug. Rumor has it Cristiano Ronaldo has his legs insured and Mariah Carey her voice, whereas Joe's mom often offers me money to stop singing. Not sure what that's all about. So, whose smile is insured for $30 million, according to rumors, which are always true? It's actress Julia Roberts. And now, to learn more about Work It, Own It with the insurance game, we welcome Amy Finkelstein.
Well, if you don't understand insurance, you are not alone. Some brilliant people don't understand insurance, and that's actually the crux of why my guest here joins me today. Amy Finkelstein joins me. How are you?
Thanks for having me, Joe. I appreciate being here.
Well, thanks for talking insurance with me, because as a fellow insurance nerd, I loved your project. I love the book, and it shines this light in an area where people get afraid. But the whole reason you started this project, and tell me if this is true, it's because some very high flying, very well-known individuals may not have known that much about how insurance compares to broccoli. Is that the story?
Yes. In fact, we jokingly thought, so our book is titled Risky Business, but we jokingly referred to it the three of us, I wrote it with my colleagues, Laurent Einev and Ray Fisman. Why is insurance different from broccoli? It was the alternative working title for the book. So the story of this goes back to the 2012 Supreme Court case over whether the Obama mandate that everyone have health insurance was constitutional. Now, we're not legal scholars or constitutional scholars, but from an economics point of view, because we're all economists, the reason for the mandate is precisely what our book is about, that why sometimes insurance markets won't work if we just let the free market run rampant. But we were struck when Supreme Court Justice Antonin Scalia asked during oral arguments, well, if a government can mandate that everyone have health insurance, can they also mandate that everyone eat their broccoli? Now, he was obviously making a rhetorical point about a, paternalistic and invasive state that is meddling too much in individuals' lives. But for us as, self-proclaimed, as you said it, insurance nerds, this just made us hit the roof. I mean, insurance is very different from broccoli, even if people tend to dislike both of them. And the reason is fundamental to understanding all kinds of frustrations and mysteries about the world around you, like why dental insurance is so crummy, why pet health insurance is so expensive, why when you apply for auto insurance, they want to know about your credit score and your grades. And the reason is the following. Insurance companies care very much about who their customers are, because the company's profits depend not just on how much insurance they sell, but on who they sell it to. If they sell it to accident-prone, risky customers or safe and careful customers. By contrast, the supermarket does not care who buys its broccoli. They care only about how much broccoli they sell.
That is kind of the aha when it comes to insurance, Amy, I think, is that the customer really matters, to your point. But hey, buy as much broccoli as you want at the grocery store. That's great. But if you're the wrong customer to an insurance company, there's a ton on the line. You shine a light on this right at the beginning with a non-insurance story, because this is all about something you call in the book selection. And I think that is short for who selects your product and who's using your product. But you tell a story about American Airlines. You mind diving into this? Because I think this is going to illuminate it for our stacker community.
Happy to do so. And that's because while selection is not a problem in broccoli, it's not a unique problem to insurance markets. Insurance markets are a particularly important example where it's a problem, but selection problems show up any time when a company's profits depend on not just how many customers buy their product, but which customers. And so we start with this story from American Airlines from the early 1980s, where they had the idea of marketing a lifetime pass of first class travel to, their high-end customers. Think about it, when you can go to an amusement park, you can either pay per ride or you can buy a pass that gets you a wristband so you can ride as many rides as you want all day long for free. So they thought of doing the same thing for first class travel. And they priced it initially at about, I think, $250,000, which in today's money would be about $750,000. So it's really, it's really a high-end thing. And they thought this would attract some rich pleasure travelers and they'd make a ton of money on it in the same way an amusement park can make money by selling these, all-day wristbands. And that's not what happened. What happened was the customers who bought it were the kinds of customers who just love to fly. One guy, for example, made 16 round-trip first-class flights from Chicago to London in the space of, I can't remember if it was like a month or a year, but a really short amount of time. Suffice it to, and that alone would have been like $125,000. So, a substantial chunk of what he'd already paid. And that was just in the first few, beginning of his lifetime pass, as it were. Suffice it to say, the American Airlines quickly discovered that they were losing money on this all-you-can-fly wristband because the people who were buying it were people who were using it on just a gazillion flights and flying all the time, kind of like we talk in the book, the George Clooney up in the air character, just constantly flying. So they did what seemed to make sense to do when you're selling a product and losing money. They raised the price to make more money. But that, unfortunately, in selection markets is exactly the wrong strategy, because what happens when you raise the price? Well, take all those like really, really, high intensity flyers who were buying the lifetime pass. It's going to discourage the least flying of all those high flyers. So the only customers who continued buying it were even more extreme in the amount they flew. So the costs per customer were just going up and up, and they raised it again. And finally, after a few years, they threw in the towel and admitted defeat and canceled the policy.
It's so interesting because, if you raise the price on me and I love to fly, I'm going to make damn sure that I get my money's worth, Amy. Like I'm going to double down.
Or if I don't think I'm going to get my money's worth, I just don't buy I won't buy it. It's only worth it if you look at it and you think, wow, yeah, that's an expensive $250,000, but boy, do I love to fly and boy, will I use it a lot.
I love this because it really shines a light on insurance and why they need to know their customers so much and why they ask reams and reams of questions. I remember back when I was a financial planner, and I know they've done a better job of looking at which information they need and what information they don't need, and which information, frankly, they can get from other sources with my permission. But I remember just pages and pages and pages of questions I'd have to ask a client if they wanted to apply for a life insurance policy. You make this statement really well about Harvard with 2 tiers of health insurance later in the book. They have a less expensive tier for people and then a more expensive tier, but one that gives you a lot better benefit. And it seems like they went into the death spiral for the same reason. Can you tell the Harvard story?
Oh, sure. It's always fun to make fun of Harvard.
As somebody who's working right across the street.
Exactly. As an MIT professor, it's always wonderful when mighty Harvard stumbles. But I actually have a bit of a personal connection to the story. So the way we know about this Harvard death spiral is because someone who was then an undergraduate at Harvard, Sarah Reber, discovered it for her senior thesis and then ended up co-authoring a paper on it with her advisor, David Cutler. I met Sarah Reber after she had done this work, and we were roommates in graduate school together. And I introduced her to her husband, which, marriage markets are another selection market, but this one luckily did not have a death spiral. So this Harvard story is near and dear to my heart. So let me explain what Sarah and David discovered for us. Harvard, like many employers, offers a range of insurance products, so a less generous and a more generous one. And at some point in the mid-1990s, they were concerned about, Harvard, of course, has a huge endowment, but nonetheless, they're always concerned about their bottom line. And in this case, they were concerned that they were losing money on some of their benefits, like health insurance. And so they did something which I think actually seems totally sensible, which is to say, look, the employer pays for your health insurance, but we're going to pay, rather than pay for most of the more generous policy, we're just going to pay for the basic policy. And if you want a more generous policy, you're going to need to pay for it yourself out of pocket, which makes sense.
It totally makes sense.
Yes, it totally makes sense. They can give everyone higher wages, and some people are going to want to spend it on trips around the world, American Airlines passes and whatnot, and some people want more health insurance. So let people decide. The problem was when they went to making people having to pay actually most of the cost of the more expensive policy, guess what happened? People who were younger, healthier, not prone to major illness were less likely to buy the more generous coverage. And so as a result, the average cost, the sort of number of doctor's visits, hospital visits of people buying that more generous coverage went up. So they had, just like American Airlines, Harvard had to raise its prices the next year on this more generous policy to cover its claims. Guess what happened? The healthiest of the customers who were buying the most generous policy stopped buying it. And there we went, round and round we went. And after a couple of years, like American Airlines, Harvard had to stop offering that policy altogether. And I want to emphasize something important. You might say, why does it matter if only the really sick people are buying the comprehensive health insurance? Let people buy what they want. As we say in the book, none of the three of us buy expensive cars, and we don't consider that a market failure. But the issue is that the point of insurance is to protect you against the vagaries and uncertainties and vicissitudes in life. And those can happen even to healthy customers, or in the case of automobile insurance, safe drivers. The whole point of insurance is that it's about the risk, the what if. And all of us, no matter how healthy we think we are or how good a driver we think we are, can end up sick or in an accident. And so we all want insurance. The problem is we don't want to pay for it when it's priced to reflect the fact that everyone else who's buying it is already suffering from several chronic conditions or known to be a terrible driver. So that's why it's a real problem when these products get driven out of existence by selection problems.
Yeah, it makes it so the least healthy among us just can't get insurance. I mean, they just can't because that pool is so dirty.
Yeah, in the case of Harvard, you couldn't get the more comprehensive coverage. You could get a more minimalist coverage. But again, even if you're healthy, some people will value the security of knowing that should they get sick, they have a very comprehensive policy that will fully protect them. And that became unavailable.
Yeah, you won't be able to get it anymore. You don't write about this in the book, but I want to extrapolate 2 areas of financial planning just based on what you've said so far that seem to make sense to me. I have read disability policies, if you're going to buy them on your own, Amy, are very expensive. And I would have to believe this is selection at work. The only people who buy long-term disability coverage, or maybe an outsized portion of people who buy long-term disability coverage, are people that know that something might happen to them, or they know inside that they have a better chance of the risk. Would you say that's got to be true? That's why it's expensive?
Absolutely. One of the challenges in doing research on this topic and writing a book on it is that many of the markets where adverse selection wreaks such havoc become incredibly small or completely go out of existence as a result. So the disability insurance market is quite small. Others go out of existence, and it's hard to study. It's sometimes even hard to think about what are the markets that don't exist because they're not in front of you. So we actually, as we talk about in the book, did what all serious research economists do and conducted a Twitter poll of our fellow economists of what are some of the kinds of insurance products that don't exist. Also we could have done, as you said, ones that are very small, like disability insurance, but we were going even more so for the ones that would be valuable but don't exist. And we got some not so serious answers like first date insurance or 10-year denial insurance, right? But one of our favorite examples, and then we actually were able to learn something about the history of this non-market. Someone pointed out that you can't buy insurance against divorce. And then, of course, they caveated quickly that they weren't looking for themselves, but just saying, there hadn't been divorce insurance. And so we actually looked into it. And this was an example of someone who tried to start a market for divorce insurance back in I think 2010. The market's, enormous. And there are well over 2 million marriages a year. And the problem is kind of obvious. Who are the couples who are going to want to buy divorce insurance? They're ones who are worried that their marriage isn't going so well and they may be headed for an expensive divorce. Now, the entrepreneur, John Logan, who started this business, wasn't fully unaware of this selection problem. He understood that divorce insurance and broccoli were different. And so he put a 4-year waiting period on the policy, right? So if you buy a policy and you divorce within the first 4 years of the policy, you're not going to get any payout. So the idea is, well, that's going to hopefully ward off the customers who are already at each other's throats. But unfortunately, this wasn't sufficient. The market did not survive. The policies were incredibly expensive, priced basically because they're expecting that even with this waiting period, the people who are going to buy it are people who are likely to get divorced. And it turned out to be worth less than just putting your money in a savings account. And that has the added advantage that if you don't get divorced, then you still have that money. So yeah, it was a really bad idea. Similarly, private insurance against layoffs suffered a very similar fate. Several entrepreneurs tried to offer it. They put in waiting periods, and yet the market just totally collapsed.
I found that case study that you go through on layoffs particularly interesting because this idea of waiting periods, and I want to get back to this in a second, Amy, because I think this is why it's important for people to read the fine print and understand what they're actually getting into, because these waiting periods are designed, according to you, to make sure that they don't attract the wrong customers. The waiting period makes it better for you as somebody holding insurance because you know that you're weeding out people that already know they're going to want to use it. But in the case of layoffs, those waiting periods weren't long enough. Like you wrote that they had a waiting period of 6 months. And in some of the stories that you tell, people are like, yeah, there was no writing on the wall a year, ahead of time, but you just kind of knew. It just felt like we were going the wrong way. So you were only going to buy that policy if you thought something bad was going to happen.
Yeah, exactly. So waiting periods are one of the quote unquote solutions to selection problems. I say quote unquote because they come at a cost. That means you don't actually have insurance during the waiting period. And some people may actually just unfortunately get laid off in the first 6 months after they bought a policy, not because they knew it was going to happen. It's the actual risk. But the flip side is what you're trying to do is prevent people from waiting until the risk has occurred to buy the policies. Like one of the central messages you could take away from our book is, as I said, the whole point of insurance is to smooth risk, to get rid of vagaries and vicissitudes. Therefore, you can't wait to buy the policy till the risk has occurred. And I can poke a little fun at my husband as an example of someone who, at least when he was in graduate school, hadn't learned this lesson. He had AAA towing insurance, but he lived about 50 miles from his childhood home, and they had a beloved childhood mechanic in his hometown that they thought did a great job. And he always thought if he ever had serious car problems, he'd take it to the hometown mechanic. Well, one day his car broke down, and he had, he's a grad student. He had the bare bones cheap AAA policy that only will tow you within 10 miles. So, ever the resourceful guy, he calls his AAA policy from the side of the road, AAA, from the side of the road where his car's broken down, and says, hey, I'd like to upgrade to the deluxe policy that, can tow for up to 100 miles. And they very accommodatingly said, sure thing, sir, and that'll go into effect in another month, right?
Like, no. I want it right now.
Yeah, well, and there's a reason he couldn't get it. So he's like the customer that the company doesn't want. He's a bad insurance customer. He's a very good husband, I will say, but I wouldn't sell him. I wouldn't try to sell him insurance. But the point is both that's why they have the waiting periods, but also buying and trying to buy quote unquote insurance after the bad event has occurred. That's not insurance, right? The whole point is to buy it before when there's just a risk.
Well, and that's interesting too. And you make that note right away that when you're buying insurance, you want to do it as early on as possible because that's your best chance of having more information than the insurance company will have about you. Over time, they'll get more about you. But this also applies to, I was thinking as I was reading, Amy, about suicide exclusions. The first 2 years on most, and I think all life insurance policies, a suicide exclusion is also, I would guess, a waiting period in a way.
Exactly.
Yeah.
I mean, another waiting period is if you've ever wondered why you're only allowed to change your health insurance typically once a year in the fall. That's another example, right? They don't want you to wait until you discover a lump in your arm to upgrade your health insurance policy.
Why do they want to give you a discount if you have a gym membership?
Yeah, that's one of my favorite examples, especially because it turns out to be true. Like, I thought it was just apocryphal when we started working on this book. So health insurance companies will sometimes offer discounts to gym memberships if you sign up with them.
Yeah.
Now, you might think that that's because the health insurance company is hoping that you're going to go to the gym, use it, be healthier, and
that's
cost them less.
exactly what I thought.
Well, you'd be incorrect. But you'd be in good company. That's what I think a lot of people think. It turns out, and we have work by the researchers Cooper and Trivedi that show this, is that what happens when you offer gym memberships is that you attract healthier customers. So a gym membership is not going to be appealing to someone who, is suffering from multiple chronic conditions and is basically homebound, couchbound, has trouble walking, etc. It's going to be appealing to the healthier among us who can at least delude ourselves into thinking, boy, we'd use that gym membership a lot if we got it. And that's precisely what they find. They find that it attracts people who are already healthier as their customers. And separately, we have really cool work from a randomized trial that 3 economists did. This is Damon Jones, Julian Reif, and David Molitor, where they actually looked at randomly offering some workers at their university, at the University of Urbana-Champaign at Illinois, offering them workplace wellness programs, and then followed and saw what happened to their health, their absenteeism, etc. And they confirmed what is unfortunately true, which is workplace wellness programs don't actually make workers healthier or more productive or less prone to absenteeism. But what they do is appeal to workers who are healthier. The ones who signed up for it were the ones who were, at baseline already in better health. And again, it's that selection. We're doing it not to change, how healthy people are, but to make sure we select or get the healthy customers.
That's interesting. Well, yeah. And if I'm an employer and I offer that type of program, I might also entice those people to want to come work for me. Healthier people's going to show up, maybe work more hours, be a
exactly
clear head. That's incredible. I want to go next to just a couple things before we say goodbye. This idea of insurance, though, still, Amy, seems very, I'm not going to say easy because you just talked about how it's not easy, but it still seems fairly simple. I put a bunch of people in a pool. I try to make sure that pool is as healthy or as not going to use it-ish as possible so that I protect the integrity of the pool. And then I pay out to people that have an occurrence and the rest of the people that get the peace of mind that if something happens to them, that it's okay. Why do insurance companies have, by far, you write, this really surprised me, the biggest lobby in Washington? It doesn't seem like there would need to be that big a lobby in Washington if this is just a cut and dry game of find your customer and learn more about them.
That's a great question. I think the reason is because insurance isn't just big business, it's big government, right? Government is incredibly involved in all kinds of insurance markets. Think, for example, unemployment insurance, disability insurance, which you mentioned before, regulation of health insurance markets. There's a Treasury official recently had a great quote. He said, the modern government, you can think about it as a large insurer with a small army on the side or something like that. I mean, a lot of what government does these days is get involved in insurance markets, either directly providing it in the case of, say, unemployment insurance and disability insurance, or regulating the market in the case of health insurance, also auto insurance, even life insurance. And the reason the government is so involved, and that's why I'm going to surmise the reason there's so many lobbyists, because once the government's involved, the lobbyists want to be involved. The reason they're so involved is precisely because these are not markets. Insurance markets are not markets that can work well on their own, precisely because of the selection problem. This is why we sometimes need government's helping hand to make the market function in the same way that governments regulate monopolies and banks to prevent bank runs and polluting firms and the like. Now, that doesn't mean they always get it right or do it well, but that's at least why they're involved.
What should our big takeaway be if I'm just the average consumer out there listening to you and I talk right now?
I would say two things. First, don't be like my husband. In a specific sense, buy insurance before you need it, right? Insurance is about risk. And especially if you think, well, you're low risk. That's in some sense when insurance is most important. It's for the things you aren't expecting, but could be potentially catastrophic, like your house suffering huge damages. But the second thing is be aware of selection and be aware that a lot of these products are going to be priced, assuming that the people who are buying them are actually high cost, high risk. So one tip I have is, in the same way you mentioned earlier about waiting periods and how they can help an insurer attract lower cost customers, that means they can be lower priced. So you may be willing to tolerate getting an insurance product with a long waiting period or a big deductible. The bigger a deductible you are willing to live with on your automobile insurance or your homeowner's insurance policy, the better deal that product is likely to be, because it's likely to attract the lower cost customers.
I don't know if it's bad for me to admit this, but I guess I'm going to help your husband out a little bit here, Amy. I will admit that on a roadside once near a convenience store where I'd locked my keys in my car, I called OnStar and tried to sign up on the spot. So they could.
Wow. I guess I didn't realize this is a general problem of male behavior.
Oh, yeah.
I will say also, going back to my plea or pitch that you should get high deductible insurance if you can. When we bought our first house, I searched high and low for the highest homeowner's deductible known to man. Mostly you can get a $500 or a $1,000 deductible. I actually found a $10,000 deductible policy, which, given how expensive a house is, it seemed worth it because the premiums were a lot lower. Now, shortly after we bought our house and that policy, there was that huge winter of 2015 in Boston where I live, where the ice dams and the snowstorms.
I remember this.
Completely blew through the deductible that year. Then the following year, we had a huge flood in our basement, also blew through the deductible, prompted my long-suffering husband to remark that it sure was expensive being married to an insurance expert. But even he will admit that if you look back over all the years we've had the policy now, even with those two years of quite high and unfortunate home damages due to the weather and due to a faulty leak in our water system, we've still saved money because the premiums are just so much lower. And really, the point of insurance is to protect against the catastrophic loss, which fortunately we have not had yet. But were we to have it, that's what we want financial protection against, not the small bore, although admittedly quite expensive stuff that comes under our deductible.
The book is called Risky Business, Why Insurance Markets Fail and What to Do About It. If you are like most Americans and you just find insurance to be a bleak and just this fog of mystery, Amy, you and your co-authors, you guys do such a great job here. I love the stories. It's just a great way to learn about insurance. This is available tomorrow everywhere, right?
Yes.
Awesome.
Yes.
Well, thanks so much for helping our stackers get literate on insurance. I appreciate it.
Thank you so much for having me on the show.
This is Daryl from Pennsylvania. When I'm not busy arguing with a 4-year-old, I'm stacking Benjamins.
No, Daddy.
Big thanks to Amy Finkelstein. I remember that American Airlines debacle offering the lifetime memberships where you got to fly forever for $250,000.
Wish I could get one of those right now, huh?
Well, like Amy and I talked about, it is the same thing as MoviePass. The people that decide to go after this stuff, the people that decide that they want this quote coverage where how many movies can I see? Very, very related to the insurance industry. Who's going to buy it? There's more, by the way, that she gets into with pet insurance, with dental coverage, some really interesting stories about why those insurances might seem very expensive, might seem incredibly expensive. But I'm glad she got to disability coverage, OG, because even though it is expensive, because so many people buy it because they fairly certain they might have a disability, it still is the one every financial planner thinks you got to examine the most.
Well, I mean, any insurance that you look at that is priced expensively, you kind of have to wonder, why is that the case? There's a reason why your house insurance costs way less than your life insurance. You know what I mean? It's like you start looking at the costs associated with it and you go, okay, well, that must mean that there's some probability there. There's some sort of outcome that I'm not contemplating down the line. So disability is one of those things that's expensive.
Absolutely. And what's interesting about that is, to your point, the probability that people are going to use it makes a lot of sense. But the piece I didn't know, and we didn't get into the whole pet insurance game, she and I, but we can do that here, is that the chance you're actually going to use your pet insurance for the average person, not that high. But the person who buys pet insurance is so into their pet that they will pay $4,500 a year for a benefit that only equals $5,000. Like they will pay this exorbitant cost because they think that, because the pet's a member of the family. And Amy walks through how pet insurance often is not a great deal, but to a pet owner, it's a whole different thing. Some big ahas there. Hey, let's throw out the Haven Lifeline. Tackle some of life's most important questions. Our friends at Haven Life Insurance Agency, OG, they put what you value first.
Right now it's dealing with insurance. Yes.
We might tell that story a little later.
Maybe.
About, yes. I think people know fun. That your car is in the garage.
Ish.
I meant the other car. Isn't there another car that's in the garage?
But that one's wrecked too.
Yes. Yeah. It's your loved ones and your time. And thank goodness your loved ones are safe and you have time to deal with this. Indeed. That's why they made buying quality term life insurance actually simple. Glad you didn't need that. Head to stackingbenjamins.com/HavenLife now for a free quote. Haven Life, they're committed to offering a modern way to buy life insurance. Their application's simple. It's online. You get an instant coverage decision from an insurer that's more than 160 years old, which is Mass Mutual. Today, let's throw out the lifeline to Mike. Say hi, Mike.
Hey, Joe and OG, 2 quickies for you. Despite your best warnings and protests, I succumbed to my inner idiocy and FOMO'd into Bitcoin and Ethereum throughout 2021. It's been an invaluable but expensive lesson. I'm currently down about 50,000 out of a total 70,000 invested. Quick picture, I'm 36 and married with a son and another on the way, have a 6 to 9 month emergency fund, have term life insurance, already maxing out my 401k, maxing out the backdoor Roth and HSA, making sure my wife is putting 20 to 30 in her SEP and funding 10K a year into my son's 529 and about to have a second son, God help me, and fund that 529 as well. So we are saving 10 to 15% of our income for these long-term goals. This is just about sunk cost fallacy. If you were me, do I just cut my L's, dump the crypto, and reallocate the remaining funds into index funds? Or given that I'm otherwise insulated and not a complete moron, do I roll the dice and give the crypto a chance to recover? Number 2, I think OG is going to tell me to go slap myself, but can you please give me the blessing to try to emulate Buffett and other value investor gods with about $30,000 of extra funds by tracking the 13 Fs? I know. Long-term, no fund manager, say for Buffett, has ever outperformed the S&P long-term. But with the fire sale on great companies right now, I figured I could try to copy the Oracle with my extra cash as well, since I'm otherwise saving well. Seriously, I know I'm not supposed to have learned anything, but you guys have changed my life. Maybe this year I'll even look into the efficient frontier and go to Bavaria so Joe can feel good about himself. I'm sorry, Doug. I need a t-shirt more than you do, bro.
Wow. Checks all the boxes.
That's a thorough listener.
Okay, Mike, wait a minute. Let me get to the crux of your question. Did you just ask us, while you make sure that your wife does responsible things and saves, that you can go out and just gamble with some money? I'm making sure my wife is responsible. And what I'd like to do is take my money to the horse track and see if I can maybe win. I already lost once. Let's see if I can win the second time.
Yeah, win it back. Well, a couple of thoughts. Firstly, right now, anyway, there's no wash sale rules on crypto. So you definitely should sell it. And even if you want to buy it back, just buy back the next minute. You know, there's some transaction costs built in there, but if you've got a 50K loss, you can turn that into a capital loss. It's too late for 2022, but you can do it for 2023 and you don't have to worry about the wash sale. So definitely kind of win on that side, if you will, in terms of the tax piece there. I don't know that anybody can really predict what the outcome is going to be of, Ethereum and Bitcoin. It seems pretty dire right now. But I also don't think that it's a terrible idea to just let it sit there. If you've got all of your other financial goals covered, I don't know why you wouldn't do other things. There's nothing wrong with it. It's no different than going and spending 20 grand on a trip to Germany.
I think that's really the key, not the trip to Germany, but whether his goals are in place or not. Because I think if he's going to need this money to reach his goals, then put it into something that reliably over long periods reaches the goal. But to your point, OG, if he's fine and he's already mapped it out and life looks good, he can afford to wait.
Yeah. The other thing that he said in there, kind of in his long-winded soliloquy of not taking a breath at the end, he said something about like no fund managers ever beaten the S&P, and that's not even remotely close to being true. People beat the S&P all the time. The problem is that it's hard to predict that person in advance, and it's usually pretty expensive. Well, let me rephrase. It's impossible to predict that person in advance, and it's usually fairly expensive to do. But there's, if you want to follow what investment managers are doing or hedge fund managers are doing, a lot of people are doing what Congress is doing, using the disclosures of congressional people to say, oh, well, they know something I don't, right. That's fine too. There's nothing wrong with that. I think that when it comes to all of this boils down to what Joe, you and I were just saying a second ago. If your financial goals are on track with the boring, easy stuff, then have fun with the other stuff. And sometimes having fun with the other stuff is going on a trip or buying a boat or a vacation house. And sometimes it's, hey, I want to invest a little differently. I want to buy an apartment building, or I want to, start a business or invest in a friend's business that I wouldn't have otherwise done it. There's multiple kind of paths here to be successful, but you also have to recognize the risk. And so you can't do it with like, this is all the money I have in the world and I need this to pay off. Otherwise I can't make the mortgage. You got to do the normal stuff and the smart stuff with that money. But if you've got extra, YOLO, as they say.
Sounds like he's got at least enough to buy his own damn t-shirt.
I think that having that sandbox for most people, OG, is just a great idea. Having a little bit of play money, because I feel like that keeps you interested in the game. It keeps you mentally engaged in the game. It also teaches you some lessons. Like maybe he didn't have to put that much money in crypto and learn a very expensive lesson there. It could have been a much cheaper lesson, but putting a $1,000 in something, I feel like you make different decisions when you invest in it. You see how much emotions are tied to it. And I think those are valuable things for us.
Good.
Correct.
Yes.
It's just, it's ended. Yep.
Yeah. Big thanks to Mike for the question and for including Doug and I there at the end, very briefly, and maybe not in the most flattering ways, but still including us. I feel good. StackingBenjamins.com/voicemail. If you'd like to ask OG and I, and even Doug, a question, and for being brave, of course, we are sending Mike out a Haven Lifeline Greatest Money Show on Earth Circus t-shirt. One of the most comfortable shirts on earth. It's fantastic. StackingBenjamins.com/voicemail, though, to get your questions answered. All right. I think that's going to do it for today. I'm super excited. If you missed the show last Wednesday, we have a new show coming out called Stacking Deeds. It's a Stacking Benjamins real estate show. More coming on that. We are going to put at least one show in the feed. The show is going to come out Tuesdays, and you're going to hear one here as an introductory show. So super excited. Alan Corey and Crystal Hammond, both two real estate pros. Super excited to have you hear more. You, of course, heard Crystal earlier on the Stacking Benjamin show early this month, and you'll hear from Alan here in the next couple of weeks on our Friday roundtable. So you get to know them a little bit, but that's coming. If you're not here though, for real estate, you're not here for our amazing TikTok minute today, where we find out how much you should probably focus on your job. You're concerned much more about recession fears ramping up. You may be feeling anxious to make some moves in your finances. Might be thinking, I've got to go buy $70,000 worth of crypto, something like that. What I'd like you to do instead is check out this free guide OG and his team put together that'll help you plan more and panic less no matter what the market does. Some great insights on what you should be doing and smart questions to ask yourself so that you make financial decisions that your future self will thank you for. Head over to stackingbenjamins.com/guide. That's stackingbenjamins.com/guide to get that free guide from OG. That's going to do it for today. Doug, I think you got it from here, man. What should we have learned today?
Well, Joe, first, take some advice from Amy Finkelstein. If you think about how insurance companies make money, you'll actually make better insurance decisions. Figure out your needs well before you need them and eliminate coverages that don't make economic sense. Second, statistics? There's a 46.5% chance this statistic was being made up right now. The big lesson? Always ensure your body parts are washed. That's what I always say. Thanks to Amy Finkelstein for joining us today. Get her book, Risky Business, Why Insurance Markets Fail and What to Do About It, anywhere you risk being buried by a stack of books. We'll also include links in our show notes at stackingbenjamins.com. This show is the property of SB Podcasts, LLC, copyright 2023, and is created by Joe Saul-Sehy. Our producer is Karen Repine. The show is written by the brilliant Paulette Perhatch with help from me, Joe, and Doc G from the Earn and Invest podcast. You can hire Paulette as your very own writing coach. With her program, Your Personal Editor, you get 10 sessions one-on-one with Paulette to add power to your words. More information at yourpersonaleditor.com. Kevin Bailey helps us take a deeper dive into all the topics covered on each episode in our newsletter called The 201. You'll find the 411 on all things money at the 201. Just go to stackingbenjamins.com/201. Tina Eichenberg makes the video version of this show. Once we bottle up all this goodness, we ship it to our engineer, the amazing Steve Stewart. Steve helps the rest of our team sound nearly as good as I do right now. Want to chat with friends about the show later? Mom's friend Gertrude is our social media coordinator and the room mother in our Facebook group called The Basement. So say hello when you see us posting online. To join all the basement fun with other stackers, type stackingbenjamins.com/basement. I'm Joe's mom's neighbor, Doug, and we'll see you next time back here at the Stacking Benjamin Show. Not only should you not take advice from these nerds, don't take advice from people you don't know. This show is for entertainment purposes only. Before making any financial decisions, speak with a real financial advisor. OG, what'd you do this weekend?
A little bit of this, a little bit of that. Nothing too exciting.
Good. This is a good story.
Boring.
This is a good story. Well,
I did not.
I wasn't really exactly prepared for this, but I will send you guys a quick little Slack message because I can't put it. I don't know how to do it on the screen. How do I do it on the screen? Can I do it on the screen? I don't think so.
It's a share screen. There's a share screen button. See that? Or is it just me? Do you guys have the share screen button?
Yeah, I have.
I do.
I have the share screen button, but that's not going to really do anything. Will Slack be sufficient? Can I Slack you?
Give me some Slack, dude.
There you go. I cut you guys some Slack. So yeah, I mean, nothing too exciting. We went, Saturday was kind of a low key day, a little exercise, watched a little football. Sunday got up, went to church like a good boy, let my kid drive home, parked the car in the garage. So
he got it all the way in.
Check Slack whenever you're ready.
That's why I asked that question. He got the car all the way in the garage.
Took it for a lap in the hallway of my house.
Oh my God. You gotta be kidding me.
That's amazing.
Oh my. So for people listening, we're looking at a picture of OG's house where there's a hallway that has the length of the garage along it where you would pull the car in. And apparently your son took a hard right into the,
Unbelievable.
He went for a drive in the hallway. Yeah. Yeah, that's gas, not brake. That's what happens when you hit the gas, not the brake, when you're pulling in the garage.
Did you at least get a, my bad?
No, he was devastated. I thought was pretty witty, although in hindsight, I wish I would have, had a couple more. After he stopped, he just went, "Oh no." And I was like, "Cool. Can we reverse out of the hallway? Maybe just knock it down into reverse." And then it was like slow motion because then we back out of the hallway. Yeah, exactly.
And all back the walls coming down around the front of your car, I'm imagining.
Well, it was a little slow motion because there was like the one, everybody's got stuff piled up in the garage. So I got like a little table or a little rack of, paint and stuff. And then the one like little paint can goes doink, falls off like onto the hood and then rolls slowly off the hood.
Did it open up? So you got a new paint job?
No, I'm definitely getting a new paint job, but not because of the paint.
Oh man.
Yeah, so
I immediately thought of in Animal House when they're trying to pull the car, Flounder's brother's car, into the garage when they were going to recreate it as the Deathmobile for the parade.
I don't remember that, but I believe you.
You don't remember this? Okay.
The movie was made prior to me being born, so the fact that I even know about it is the fact that you know about points.
Animal House. Wow.
So
that is bad, Doug. That is bad. That is so bad.
So,
but with Amy being here today, talking about insurance, OG is.
Yeah, that was the other thing. So the part where they say on the commercial, like, and we don't raise your rates for one accident. Well, Mrs. OG's car is in the shop right now because of an accident. My car will be in the shop in the next day because of an accident. And my house will be in the shop because of an accident. They're all insured by the same people.
Are your bikes in good working order?
Exactly. But it's a little bit like Yellowstone. You fall off the horse, you got to get back on it. So I'm going to make him go drive again today. So that's
good. Everybody, if you're out walking in the Dallas metro area, wear a vest.
You're safe on the roads.
Wear a hard hat.